Finance Committee of February 11th, 2020 is called to order. Lisa has already done it, but Lisa, would you want to do the budget?
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Will the Secretary please call the roll?
Director Frank? Not here.
Not here today.
Director O'Brien? Here. Director Zaletsky? Here. Director Russo?
Here.
Director Simsek? Here. Director Mendoza? Here. Director Huntar?
Here.
Director Apple?
He's not able to be here tonight.
Director Schreiber?
Here. So Superintendent Kreiner, if you want to, your first position, Finance Committee, you know, lead us off.
Yes, sir. Yes, my privilege to introduce Chris Jeswick. He's going to take us through the process of reviewing financial statements from the 2018-2019 school year.
Okay, so we're going to give a basic financial report. We're going to go over some things where we're at, real estate, tax collection, where we are with our revenues and expenditures for this year. Just a couple of reviews with the referendum exceptions and stuff. But first, I'm going to have Steve Nightenberger present our audited financial statements as we wrapped that up about a month ago where the official reports were up, and Steve does this yearly for us, so I'm sure everybody's familiar with Steve.
Good evening, everyone. Just going to take a few minutes to go through the 2018-2019 school year financial statements. That's for the year ending June 30th, 2019. If I go along, I'll point out some exhibit numbers, page numbers. If you have any questions as I go along, please feel free to interrupt, or at the end I'll give you an opportunity for some questions too. Everybody have an audit report in front of them? I brought a couple extra for just in case.
Could we get one?
I don't know.
I only have about 4 left, but if you request one, I can send it out via email.
I meant just to look along.
Yeah, if you can return it for me.
Yeah, I won't write on it.
Oh, that's okay.
I just wanted to.
Thank you.
Thank you.
All right, so the first thing I want to draw your attention to in the audit report is actually the letter on the first 3 pages. That's the independent auditor's report. That's the letter that we provide to your financial statements. That's basically our auditor's opinion on the financials. The technical term for it is unqualified opinion, which is known as the highest level opinion we can provide on your financial statements. It's also known in many circles as a clean opinion on your financial statements. I'm going to take a few minutes to look at some of the exhibits that are more like the basis you budget on and look at probably on a monthly basis at your board meetings. As everyone knows, there's a few extra exhibits in the front that sort of put your financial statements in the order that your bondholders and any creditors would look at, but that includes a lot of actuarial liabilities and also long-term debt and things like that. I won't go into too great detail about those. We'll focus in on the exhibits that you guys look at regularly. The first exhibit is actually on page 17, exhibit 3. This is the balance sheet for the governmental funds of the district. The main operating fund is the general fund. That's your first column there on page 17. And you can see that your total assets at the end of the year were $9.5 million, while your total liabilities were about $3.9 million. You had unavailable property tax resources about $2.4 million, which resulted in your fund balance of $3,094,000 at year end. We'll go into a little more detail about your fund balance in a moment. I also want to point out while we're on this page, the capital projects fund had cash of $74,000 and also had a restricted fund balance of $74,000. If you flip a couple pages forward to exhibit 5 on page 19, it's these same 2 governmental funds, the general fund and the capital projects fund. This shows the results of the operations for the 18-19 year. You see in the general fund, the total revenues were about $28.7 million, while your total expenditures were $28.3. This resulted in a $373,000 surplus of revenues over expenditures, which increased your beginning fund balance of $2.7 to the $3,094,000 we spoke of a moment ago. The results for the capital projects fund also on this page. You see you had interest earnings of about $7,100, and you had total expenditures of $3.5 million. 3.3 of that related to your project, your train project, the energy efficiency project that was conducted during the 18-19 year. And you also see you had a little bit of proceeds from a new lease of about $155,000. So with all that activity in your capital projects fund, your fund balance decreased from about 3.4 at the beginning of the year to the 74,500 at the end of the year. Another fund type actually at the district starts on page 22. It's a proprietary fund, it's your food service fund. Now this fund is put on the basis more like corporate financial statements. So the thing I want to point out at the bottom, the very bottom line on page 22, your total net position is a negative 103,000. However, I want to point out that about 2/3 down the page, you see there's a net pension liability of 574,000. So if this 574,000 net pension liability wasn't in existence, you'd see that you actually have a surplus all the time in your net assets in the food service fund of under 400,000. The next exhibit on page, yes.
Could you explain to the board what the net pension liability is, why it's there, and why you've analyzed the fund, the balance as you did?
Yes, probably about 5 years ago, the net pension liability had to be put on the face of your financial statements like Exhibit 1, 2, there's reconciliation statement 4 and 6, and then it's also on your proprietary fund, your food service fund. What it is PSERS administers the retirement payments to your employees once they've retired. You fund PSERS, like the rate for this past year was about 33%, the 18-19 year. And so what's happening is you're funding that in your regular expenditures, and they're actually paying out for your retirees. In theory, the districts are backing that just in case something would happen to PSERS. It's a state retirement system for all the districts and other types of schools in the state of Pennsylvania. So what happened was they came out and said, well, we need to see the full picture of your financial statements. So that liability, actuaries go in and they calculate what amount relates to Carlynton School District of the total PSERS pension liability. And what they calculated, and not to make it very complicated, that the 574,000, that's actually for June 30th, 18, and there's deferred inflows and deferred outflows that reconcile between June 30th, 2018 to June 30th, 2019, because PSERS obviously has an audit also, and just for timely inclusion, the data doesn't come out to put the June 30th, 2019 stuff in this financial statement. But in any event, that's really to put your full liabilities on there. You have other post-employment liability, you have this net pension liability, and as I just briefly mentioned, it's also putting any bonds or compensated absences, along with any fixed assets of the school district onto the financial statements. So unfortunately, because the food service fund is thought to be an internal service fund and operates on its own, that liability has to be put on there. There's also a portion of the OPEB liability, 24,000, that's also PSERS portion. So what in effect is the district's total liability for pensions is much more, but the amount that relates to your food service employees is 574 for pension and 24,000 for OPEB. So that just gives a little idea. I know that gets a little, probably extended there, but so that's why I just like to cut to the bottom line of the results of what you're looking at regularly. And on the next page, page 23, Exhibit 8, you can see that your fund balance actually improved from a negative 127,000 in the method with the net pension liability to 103 that we spoke of previously. And just to give some perspective on that, you see the change there during the year, the 23,000 positive, that's actually the change in the net pension and OPEB liabilities. You're pretty much right at the break even otherwise for your food service fund. The final fund type is actually on Exhibit 10. It's the student activity funds, that's on page 26. And I just want to point out you had over 86,000 in cash in your student activities at June 30th, 2019. I very briefly mentioned when we were on Exhibit 3 with the balance sheet, I mentioned about the general fund balance. I just want to go back to that for a second. On page 34, I'm just going to take you a couple highlights of the financial statement notes. On page 34, it does talk about a couple things with the general fund balance. You see there that there is a non-spendable amount in the general fund that's actually to match your prepaids in the amount of $305,000, and then also you have $422,500 that's assigned for future retirement expenditures. So just to keep in mind how it showed on Exhibit 3 that you had a total fund balance. There are portions that are non-spendable and also assigned of that fund balance. Your total fund balance was a little over $3 million, but only the unassigned was a little over $2.3. A couple other real quick highlights in the notes. You have your bond outstanding still, which you took out a couple of years ago. That's on page 38. You see that you owe $4,590,000 on the bond. That was the Fund Your Train project primarily. There's a lot of other notes that go into those actuarial assumptions and liabilities, but I'm not going to go into any of those unless someone wanted to. The next thing I wanted to focus on was on page 56. It starts, this is the budget to actual analysis for the 18-19 school year. I'll actually draw your attention to page 57 first. About a third of the way down on page 57, you'll see that you had total revenues budget of about $28.1 million, while your revenues came in at $28.7. So you had about a $626,000 positive revenues exceeding your budget for 18-19. On the other side, the expenditures, if you flip to page 62, you see that the fourth line from the bottom on page 62 is the total expenditures and other financing uses. You see you budgeted about $28.4 million, while your total expenditures came in at about $28.3. You were actually $63,000 less spent than budgeted, which shows strong fiscal management. So when you take the $626,000 surplus in the revenues over budget and the $63,000 expenditures less than budget, you get to your net change of $690,000 that your actual exceeded your budget for the 18-19 year. And you see there that the third line, the third column from the left, your actual is $373,000, but you budgeted a negative $317 in fund balance, the change. And then the final piece of this audit report is really the last number of pages, beginning on page 69. It's your single audit. Anytime you have $750,000 or more federal expenditures, you have to conduct a single audit. In Carlynton's case for the school year, it was $1,696,000 for the 18-19 school year, so of course we had to conduct a single audit. And there's a number of letters and everything documenting that, but I'll just say that those letters are clean. We didn't have any findings or question costs of any nature in your federal expenditures. We tested Title I, one of your main programs during the 18-19 year. It was a major program, and pleased to say that everything there is clean with the single audit also. So I know that's a lot of information. It goes in a few different directions there between the single audit, budget to actual analysis, and just highlighting some of the basic results. Is there anything I said, or anybody have any other questions that I could?
Just to summarize what you said, so we had budgeted a negative $300,000,
Yes.
negative $300,000 budget. Our actuals were roughly positive $300,000 and change, so we have $600,000 swing. The food service is showing negative $100,000, but because of that pension liability, which is an accounting.
Governmental kind of standards board dictates how these financial statements have to look, and it's.
But operationally, we
yeah.
have a
Operationally,
$100,000 surplus.
Operationally, overall time, you have a positive fund balance and net assets, you could say, over 400,000 all time total.
And for us, that's stuff we can only use for food service related items. So if we have kitchen upgrades or food service stuff that we need.
Cafeteria tables, anything, right?
Anything that's not built in to the building.
Right.
And over the last number of years, sometimes you have done a capital type item purchase out of your food service fund that relates to food service, which you're able to do. So.
And food itself, we can actually spend it on food, right, for like the kids.
Well, essentially what you do is they don't want to purchase it, but they give us the bill and through all their expenditures, yes. We don't buy it directly, but it's through the contractor, we get billed.
Okay.
Food, what we were able to purchase because of our strong financial standing, that we were able to upgrade the tables and upgrade certain things that we were able to purchase. Now, when we build in the walk-in cola, we can't purchase that with cafeteria funds.
We can't.
No,
It's
it's,
just built in.
yes. So if they can pull it out, if you can pull it out with the cafeteria, everything, like a table,
Yep.
you buy it. If it's built in, it's a fixture to the building.
Gotcha. Okay.
And, you're going over the highlights. And yes, the capital projects were significant for Carlynton this past year because for many years there wasn't a capital projects fund. We sort of got that on the books the previous audit, the 6/30/18, but the project was almost 100%, I believe, done during the 18-19 school year.
Mhm.
So that was a significant difference. I mean, I
Is
sort of
is
went
the
over-
project completed now?
Yes.
So we started the current year, we ended this audit year with a $74,000 balance in the capital project fund. Was it completed as of this audit, was it completed subsequently in the current year?
It was completed in the 18-19 school year, February 2019.
Okay.
February.
What happens to that 74,000?
Well, that 74,000, and Steve helped work with this. We were able to put it to another capital project because we can only hold it so long. And
Did that this year?
Yes, and that was the HVAC repairs we did out in Craft and
So next year's audit, we should expect to see that fund
zero.
balance zeroed out.
Yeah.
It's zeroed out currently.
Thank you.
Maybe $6 in it.
When you did your bond, of course, you had other capital needs in there besides that, so it was able to be used for other capital needs of the district.
Which was nice, and that's where we paid that 90% up front to train, where I believe we got 5% for every month the project lasted. So I think that netted us around $48,000. So that aided us in helping fix some of the HVAC issues we had. So that actually worked out great, that because we weren't going to get 5% for anything we invested the money at. So us paying that up front, the train, we're getting 5% off of that, which really enabled us to clean up that HVAC project down at Crafton.
Steve, I have a question on page 49 of that chart. It starts out in 2020, 73, $397, and thereafter in 2025, it's a 6-digit figure. Is that good for us or bad? What is the reasoning for that big change?
Okay, and let's keep this in context too, what this actually is. This is the end of the footnote for the other post-employment benefits, the district plan. So there's two different plans. There's the PSERS plan that's part of your pension plan, and then this is part of the district plan. So it's what the district gives retirees towards their health and other benefits after they've retired. So you have a private actuary that comes in who performs a calculation where all these numbers come from, actually. And what they basically are doing is they're listing out the next 5 years, 2020 to 2024, and they're saying approximately 73,397. And then thereafter relates to all the years after that. So that 267,000 captures a number of years.
Cumulatively.
Yeah, so that's why it's such a large change. That's really what that is. And as far as whether that's a positive or negative for you, the only thing I can say is if you flip back to page 48, at the bottom there you see the deferred outflows and deferred inflows, and that goes back to the whole idea of these actuarial liabilities are calculated on a different date than these financial statements. So you have inflows and outflows, money being paid towards them, liability being accrued towards them. Actually, outflows exceeding inflows is a positive thing, so these are actually positive numbers. But once again, and I hate to talk about this stuff a lot at board meetings because it does get confusing, these aren't real numbers. You are funding these things through your normal expenditures in your general fund. These are just the actuarial calculations to get these large liability numbers on your financial statements for reporting purposes required, and also for bondholders and everything. Basically what happens is you're obviously a government. While they're giving you the bond, they want to compare you to a for-profit corporation, and this is one of the manners they try to do that. So, and we review the actuarial assumptions behind those reports, but when our actuaries, we're sort of using, that's why we have a third-party actuary that does that work. So.
On page 17, you have the deferred inflows, the $2.5 million property tax number. Is that uncollected or likely not to be collected?
That's actually, in theory, over all time, still going to be collected. What basically happens is that's from whatever year this district started, people who have not paid their property tax. So what's done is, once again, your delinquent collector prepares a report that says, okay, these are the balances we're still trying to collect. Then we basically do a thing that says, okay, the stuff from 1920 or whenever, it's not being collected, right? But the most recent year might be 70% still collectible, and then it's sort of a calculation like that. So anyways, that 2.496 is after assuming an allowance for doubtful accounts, the number that still should be collected over time. And just to give a perspective of the 2.4 versus what actually happens each year, if you flip to page 56, page 56, line 5 down, delinquencies on taxes, you see you collected $936,000 in the year. Now, the bulk of that is real estate. There's a little bit of earned income tax collections in there too to distort that number. But you do see on average, probably around 900,000 you're collecting. So your amount on the balance sheet is 2.4. Well, each year, your current year, you're adding to it, but you're also collecting. So you've actually had a decrease in that number over the years. So, I mean, that's sort of good. You're collecting more than the average sort of what's expected with the receivable. But that's another one of those numbers that, on the governmental statements, that's the only number that isn't a hard number. That's just an estimate, that number there.
But just for clarity again, the 2.5 Jim was talking about is, in essence, delinquent taxes.
Right.
That number, when it's collected, decreases, and it shows as an increase on the financials, delinquent taxes under revenue. That's how they relate to it.
Right, yeah, and not further, that's actually the liability, the deferred inflow side, basically, because we're required to gross up your balance sheet. In the receivable number of about $3 million, on that same exhibit 3 on page 17, $3,014,000, 2.4 of that relates to delinquent real estate. So basically that 2.4 million is just an offset. It has to be in your receivables, but it's also out there as a liability, like a deferred revenue, because the collectability of that is highly in question. And I mean, that's a big number, but it's no different than in other districts. Those numbers get quite large. Unless you sell your delinquents, then that receivable and liability is not on your balance sheet.
We spoke or discussed once of selling the delinquencies. Is that?
Usually, districts that are fairly, how do I want to say this, not economically in great standing do that. We've seen it, we audited about 33 districts in Western Pennsylvania, our firm. And it's usually the districts that are not in real great financial standings that do that, because remember, you're paying the company to do that, and you're sort of getting big discounts on that.
You can't even sell those 1920 names.
Yeah, I mean,
Nobody will buy them, I mean.
right, I mean, actually what comes in is, let's say the real
You're
number is
getting
5.
percentages on dollars decreasing as
Right.
the years go by, so I mean, I think Steve is correct, George, if you need a cash inflow, that's a way to do it, but you're selling them at discounted rates.
It's a loan.
Yeah, and
Yeah,
basically,
in effect, it's a loan.
a lot of times it's a district that may be in a deficit or their just cash flow is really bad, so they'll take that shot of $1 million this year. But then after that, that is not as big each year. And then if you ever decide to start going the other way, you're gonna have that hole in your budget of that amount for the
Yeah.
year that you change
I
that.
mean, just to take the 2.4, you're not
You're not
selling those.
gonna do that. If you got 800,
Nobody's buying
900,
most of
maybe.
them, there's just no market for them.
And our delinquent tax collections have been pretty good from what you
Those
said.
guys are excellent.
Yeah.
You guys did change a few years back, I believe, and the collections have been pretty high, right? I don't know what it said. No, I mean, you see, different, firms and stuff. You see,
From my
usually when you
department,
get a
the
new
firm
firm in for a few years, you'll see the amount really being high, and some do better than others. I mean, especially if they have legal side, legal backing, so.
To recap, the other thing you had mentioned, so the revenues, $600,000 surplus over budget.
Yeah.
Of that, roughly 600 grand or 500 and some grand was revenues, increased revenues. There's like 50 or 60 or $100,000 of reduced spending. Is that roughly correct?
Right, the spending was in the, I believe, 60-some thousand to the good, which is good. I mean, you went under your budget as far as the amount that you actually expended. On the revenue side is really what made it up, and it really points to a couple items. On page 56, current real estate, which is the biggest revenue, it was 178,000 over the budgeted amount. And then your earned income tax, one of your other largest revenues, was 135,000. So if you take the 178 and the 135, you're well over 300,000 of your 600,000. Then your state and federal monies, they also showed a surplus. The state about 84,000 and your federal 110. So it's always good. You don't have a lot of control over, what your state and federal roughly are going to be. What dictates to the federal is how much was spent. But what you like to see is on the local levels that you're getting more than budget. I mean, once again, percent-wise, they're not real high, but they're still dollar-wise, that improvement.
One last question for me, and this might be for Chris, or either of you. On page 26, I think you noticed, or you noted about student activities funds. Is that both athletic and activities?
No, that's just the activities fund. The athletic fund changed under GASB 54, probably about 8 to 10 years ago. It has to be part of your general fund. So you still have an athletic fund here at the district, but we combine that into your general fund, and then, you know,
We
there's
do the
small stats
transfer.
and everything.
Okay.
Because that's a governmental fund, where the student activities fund is really a fiduciary fund. They're different because the students really control those monies. You're just on a fiduciary basis. That's why it's shown as other current liability. What money is sitting there is also a liability. The students have really control of that. Where the athletic fund, the district actually controls that. The students aren't having any say or anything in that. So, years back, if you look back at financial statements, that would be a separate fund, but that changed.
That's where we always pay somebody that would be a ticket taker, as Michelle volunteers quite a bit, so.
And really how schools set up those funds is so different among schools. I mean, some have it already in their general fund, some have it as separate athletic funds, some have all their expenditures in there, some just have officials' expenditures. I mean, you could really have that set up differently, but it's all combined in your financial statements now anyways.
Anybody else have? John?
All right, well, thank you for your time.
Thank you.
And if you do have any further questions, I know it's a lot of information, some of it gets a little bit confusing because it's a lot more than what you guys are just looking at regularly. If you could just forward them to Chris and he'll get them on back with me, and be glad to get any further explanation or anything.
Great. Thank you.
All right, thank you.
Thank you.
Have a good night.
Thank you.
All right, so hopefully everybody got their questions in with Steve. So what I gave a little packet tonight to give us our budget updates and collections. The first is the 1920 real estate tax collections, as we're wrapping up now in January. We're almost at 91% collection. I have about $15,575,000 that we collected in real estate taxes. So with 91%, that's a pretty good collection rate, as our tax rate, millage rate has went up. So we've maintained that. And this is just a reconciliation, as we get a reconciliation from Georgia Tax Services each month. As you can see, November, I did not get that one, so I need to reach back out to them and request that again. So just wanted to give, so if you want to review that, see where we're at real estate tax wise. Second page, I gave a statement on revenues and expenditures for 1920, and that's a 2-page form. And then just right after that is 1819, which is also a 2-page form. So I want to give you, they're as of January 31st. So what I wanted to do here is just give you a year-to-year comparison with that, so we can kind of see where we are versus budget. As you see, we budgeted $28.874 million for revenue. Last year, we budgeted $28.138 million for revenue. Right now, we're up to collections of $20.5 million on revenue. That includes state, local, federal, so far monies that have come in. Last year at this point, we had $19.9 million in revenue collected from all our revenue resources, once again, state, local, federal. So if you flip to the back page of the 1920,
Chris, just to interrupt real quick. So
Sure.
did you just say that we have 25 million collected so
20,
far?
20.5
20,
million.
okay, I
Yeah.
apologize, okay, thanks.
So if you flip to page 2 on 1920 and 1819, you can see the budget amounts. We went up a little bit over about $1.1 million in budgeted expenses. So our current year actual right now expenses that have come in. Now, remember with the expenses that came in, general employees such as myself, Dennis, Dr. Kreider, we are on the normal school year, July 1 to June 30th. The teachers, aides, they go from September 1 payroll to August 31st. So that's why we have to wait till October to really close our books. So we're 11, I think we're about 11/24 through payroll. Well, actually on this one, we're 10. I was thinking I was doing my budget. So we're 10/24 through the payroll. We've done 10 pays out of 24. This is where we're at. So we're at $13.6 million in expenditures at this time this year. Last year at this time, we were at 13.679. So we're actually a little higher with our expenditures last year at this point. And one of the things you look at, and Dr. Ryder and I were going over this, we have, outside of salary and benefits, we have about $3.2 million remaining where we have expenditure-wise, our flexibility with remaining supplies. We have done an invoice cut of March 1st this year. I think Dr. Cryer was even talking about pumping that up to February 15th at some point. So what we want is, unless it's an emergency, hey, principals have your supplies and graduation supplies, just little things so it's not last second. So we can really see where we're at, because one of the things we wanted to move forward with was one of the elementary. We discussed, Lauren, when we had our meetings about the capital projects and stuff. We had about 22, 23 grand we wanted to put into repairs for one of the elementary auditoriums. But we're going to move forward with that project. We're going to get that pricing together. Our athletic department, they've done a good job with budgeting. We've had, with the influx of kids we've had coming in to play football middle school, we're needing to upgrade some of our equipment. So we're looking into ordering about 30 helmets. That's going to be a $10,000 expenditure, but it's just needed for safety purposes and for the amount of kids we have coming in. So some of those things like that, we're going to be able to make those purchases for this year because of where we're currently at with the budget. So we'll see where we end up with anything. Like Steve said, it's pretty hard to predict some of this, but I think as long as we stay within our expenditure budget, we shouldn't end up in too bad of a place with everything. We budgeted 711, but I'm not going to give any predictions right now on where we'll end up. As I've learned, that's difficult to do. Some additional, we've applied for the referendum exceptions. We did qualify for the special ed exception. I think we've sent out an email. With that, we have to wait until, and I think Dr. Carter, you put the special ed exemption form in on one document for the board, the attachment,
Right.
So you're able to review that. We have to wait till March 4th to determine if we're allowed to use that exception. So the state determines that. They've called, asked a couple questions. Hey, in a couple areas we were 0. The following year we were 305,000, 72,000. With the restructuring of how they use the code, say the special ed department director, they use the code. That individual, one set of pupil services. Well, we moved that to 2260, which gave us an increase of $305,000 in that area. And then social worker services. So it's just been kind of a recoding. Let's bump this, and it should allow us to get the special ed, but we have to wait on the state. I believe the budget timeline that I have says March 4th. We should know by March 4th whether we are okay for that.
If I can interrupt real quick. The
Sure.
special ed exception, that's something that can vary each year, where it's just based on whatever you spent the prior year and you submitted.
Yes, it's how much of a difference you have. Like last year, we didn't qualify for it because we didn't have enough of an increase on our special ed. So it's you don't want your special ed name, you don't want your costs to increase, but at least if they do, you have the ability. So
Some of the money.
yeah, that could allow us to go up a full mil versus the 0.8 to 0.9 mil.
And actually, correct me if I'm wrong, the special ed exception will give you an increase to cover those increased costs beyond what is already covered by the index increase.
Yes,
Okay.
yes.
Right, so there's a certain amount you're getting with the index. You'd expect a normal increase, but it's where you go beyond that, the exception kicks in, and that'll be covered entirely. With the exceptional grant, an additional tax increase to cover that incremental amount entirely. I'm asking, I'm not saying. Is my understanding correct?
I'm trying to think through how you
And I don't mean to put you on the spot. I mean, but I think the key takeaway here is it recognizes that the index is covering some of it. Or is it
Yes.
Beyond that is where the exception.
Yeah, we have up to our index, which they've approved already, because say here's an example of it. When I put in that we're putting in a tax rate above that index, the system will kick it out. It will only let me go up to what our index. So if I put up say the 24.9, we went from 24.1815 mils, we go up to 24.9. That's within that 3.2% index jump that we had. But if I put the full mill, 25.1815, it kicks it out, and I'm required to go in and put a validation of, here's why we're going above index, we're applying for the referendum exceptions. So that it does give us that tax increase over that. And then you get into, depends on your collection rate for what you're putting in. It's supposed to give you a certain amount of revenue, but it depends how much we are able to bring in. So So that was, just wanted to give you an update on the referendum exceptions. And then secondly, I went to a PASBO meeting on maybe last Thursday or Friday last week. And they gave us kind of updates on all the state budget and stuff and where it could be a little wild card. They said they're giving out an extra $100 million for basic education funding, but when you divide that by 500 school districts and charters and everybody gets basic education funding, you know, I'd be happy if we got anywhere in that $10,000 to $30,000 window additional. So I don't expect much from that. They went through the whole process. They told us changes in charter school laws and all these positive things that would be wonderful for us. They said the likelihood of any of it happening is very small. So they throw out, hey, there might be a pot of gold at the end of the rainbow, and their expectation is don't expect anything to happen. Budget as if charter schools are going to stay the same, because one mention was, hey, it costs, instead of the $14,000 we're paying for regular ed, it would go to $9,500 because that's the average cost of the cyber school, which would be great for us. It would be a $5,000 discount. But there's no expectation of that right now, because I think there's a big money player that supports charter schools with one of the representatives. So went through that, just gave us the importance of doing our special ed forms correctly, so we're getting full special ed funding, which that goes up, so we should expect it. But they said, you know, it's hard to predict what your special ed is because they're still working on what they're giving you in 18-19 right now. So they can't tell you what it's going to be in 19-20. So it's just a constant flow of an unknown. So I think a hold harmless is probably a good strategy on the state funding, but that's just where we're at with everything. So they tell you a lot, but it's not really going anywhere. Anything positive that I would like to report on that.
So then, go back to the audit report, that difference that we had where we did better than what we budgeted, those items that he pointed out in the back, those are really things we can't control or count on, because there was also a chance it could have gone the other direction. And
What, with the funding, you mean?
well, when we talked about, you know, what we collected and then talking about state and federal, or those things identified why we probably had that difference. Is that, those are things that we can.
I mean, you can, your delinquent taxes could fluctuate 100.
Right, so.
I could sit there and say, oh, we made $947 in delinquent taxes last year, and then next year it could fall to $850. I don't think it would, because we have wonderful collectors. I don't think it would ever fall that far, but we fall $850, I budget $940, that's a $100,000 swing.
Right.
Or another difference is we had a positive on the transportation. Transportation subsidy is always one they're discussing, and it can flip based on consumer price index.
Right, so what I'm understanding with the things that he pointed out, those were things that it could have, like you said, fluctuated in the other direction. Like, we can't depend on that next year, like, we may have this variance again.
Like, that's why I'm always careful with revenue and not going too
Generally.
strong with it. You know, I try to keep it somewhat consistent with the previous year with somewhat of a bump. Like,
Right, I mean, that's the closest you can use
Yeah.
to try and mark where you're gonna try and budget, but like, well, just like that, you know, it's not that, because I don't want this to look like you're off, your accounting is bad, because to say that we're off in the good is just as bad as saying we're off in the bad. You know
I
what
think
mean?
it was reasonably budgeted. We stayed
Right,
within
but that's
our
what I'm saying, like,
expenses
I don't
and
want that
revenues
to be
were-
mistaken that because your accounting was good and we.
No, I think if you compare it to other schools, we're probably on the very good side of being close to expenses.
Right, and that's why I just want to be clear, but that's emphasizing the monies that came in, this revenue was really not predictable, and we can't depend on it being like that every year kind of thing.
Bruce, I agree. I think it's a good point.
Yeah, you never know. Like, say our investments, we brought in a lot of money with our interest earned, but you know, I had one CD that was in there for 2.75. I had 2.3s. This year I'm seeing 1.7, 1.8. So it's going to flip. Now this year I had enough that was flipping over in July, where we're probably going to see close to the number we were at last year. But next year we might be half of that. You just can't completely predict the interest rates.
Okay.
So if I understand what you're saying, you're always budgeting revenue conservatively, so that we can more typically than not expect to finish better than we budgeted. Is that a fair thing to say?
I think it's so you don't, the way I would put that is I would hate to exceed and show too optimistic of a view with our revenue, because then that's where I feel we would get in danger of, we don't want to go too bold or do things we don't need to do for the future.
If we have an item that often is about $1 million, but we have a 10% fluctuation either way, are you gonna budget that at $900,000?
It would just all depend on what one and what I'm hearing through, organization, state. There's ways you can view it, and it depends on what individual item.
We had an audit report just presented to us where we finished in excess of $600,000 better in revenue. Your handout suggests that the current year is following a similar trend.
Yes.
Can we expect a $600,000 to the good in revenue this year as well?
I can't say that right now.
What would change? Why would it be different based on what you've just shared with us? Given how you budgeted and given how we are through 7 months of the year. I mean, what could change in the last 5 months?
Well, you have to do an overall invoice check and see what's come in, what hasn't come in.
We can have
It would
repairs
be
that we don't
a bigger
expect.
overview of a.
But I mean, in reality, we budget to always finish better than revenue. I mean, that's just the reality, isn't it?
Because you never want to under.
For whatever reason.
I don't know.
We're always finishing budget. And this goes specifically toward discussions we've had about how we're gonna deal with our fund balance depleting. And my concern is that I don't know how we do that without an understanding of where we are most likely going to be hitting the mark in terms of our spending. If our budgets are designed purposely to avoid not having sufficient revenue, we are in essence always going to be inclined toward underestimating revenue as opposed to trying to hit exactly what it is. And this is not criticism, it's trying to understand what the process is, what it's been historically, and what it's been historically with other districts. I contend we're in a very different time now financially than we've been. Not just this district, but all districts throughout the state. I mean, I think Act 1 of 2006 is finally coming to roost, where as a result of not being able to raise revenues as much as we needed from time to time, we're up against it right now. And Jim, you and I just talked about having to deal with the PSERS increase, and the charter school increases.
The jump on your PSERS increase, they're talking about over the next 5 to 7 years, we're gonna be up to 40% at some point, so that's not slowing down.
They're calling, the highest I've seen is about where we are right now, or a little bit
They
higher.
said we could see
They're
40
gonna
in
change
7
that now?
years.
PSERS hasn't said that though.
They said we're plateauing, they didn't say that.
That's what PSERS said.
But that was a
Right.
actuary that PASBO had, they're looking at it going.
But PSERS' position is that this is the plan and this is where we are. So we're plateauing. Isn't that what PSERS has said?
Well, what do they consider plateauing?
The bottom line is, if we don't have an accurate picture of what we believe our spending and our revenues are gonna be, I don't know how we can accurately put together a plan to responsibly utilize what limited fund balance we have over the next few years. Now, we may not have an issue, and we may be fine, or we may find, if we're budgeting an $859,000 deficit for the 2021 year, and we finish with an $800,000 deficit, we're gonna say, great, we finished under budget. And I say, we're in big trouble having used $800,000 of that fund balance.
Right.
That's where I'm going with this, what I'm concerned about, and trying to understand how we're managing the process of budgeting right now.
I wanted to not interrupt you. I was on the verge of interrupting like 4 times, so I apologize. I get your point, and the more I think about it, I think, and I'd like everybody else to share your opinions, but I think I'm more comfortable with, like, the way things ended up. We were about 2% higher on revenues than we expected, 600 grand out of 28 million. And I would rather do that than be 1% light on revenue. And that may not be the board's opinion, that might be just me, but like in my own personal finance, I would prefer to have a 2% overage in revenue coming in, because I can manage that a little bit better. Being under can be challenging, and especially with us with limited funds, if we end up light, and I think you said, I don't want to put words in your mouth, but I think you said you're perceiving that there's a danger in ending up light. So if there is an error to be made, we better err on the side of having
And
more.
I'll give you an example of a curveball we got.
You know what, let me just, I'm sorry. Jim, I agree with you. If we have a balanced budget, I'm 100% with you. But if we're using fund balance,
Well, I guess,
We're committing to using a certain amount right there.
Right.
And that's the concern. And if we budget to use it and we use it, we're saying it's okay.
yeah.
How do we have a plan on how we're gonna use this?
I would suggest this, like hypothetically, and let's get back to your point just real quick. Hypothetically, this next budget year, let's say we hypothetically end up on a $500,000 budget in the red, a deficit, $500,000 deficit for our budget for next year. Knowing that our historical planning tools have given us a little bit more revenue than we expect, in the back of our head, we might be saying, okay, well, 500 grand deficit makes us nervous and is not good. But if our traditional accounting holds up, then maybe that $500,000 negative budget becomes a minus $200,000 budget. And given the things that we're trying to do and given our fund balance, maybe, and this is all hypothetical, maybe that's okay. And
So
we can
always
bake that into the program.
building it, budgeting with a cushion? I guess I just find it hard because like we're asking administration and everything to like really get tight on things, but it's hard to let them make some of these tough decisions if there's actually like some money in the back.
I
You know what
agree,
mean?
I agree.
So it's just, I'd rather be, and I understand there's a confidence interval, like, Chris, like, I'm sure there's no specific, like, within $10 of having this is what it's gonna be. There's a confidence interval. So this is like, you know, is this acceptable, this overage, this done better than budgeted, is that acceptable in this confidence interval, or is it something so excessively over, just as we can be so excessively under? It's just,
I know people that work for big four accounting firms that are very high up there.
Yeah.
And I asked them how our budget variance was to actual. They said that's not even something they would review.
okay.
So that's an opinion from that type of professional. It's a principal.
But to our
of one of
standard
those
for where
firms,
we're
so.
trying to close this.
I understand that, but
I mean, in practice,
is
I
over
understand,
budget,
like, for our goals.
here would be my question, though, if we're getting close to going over budget, are we gonna not do things we have to do to maintain a budget?
But if we under budget, then we're constantly, you know what I mean? Because like if we're feeling, like if that's built in, then it kind of gives me, it doesn't give me confidence in things that I'm asking. Because what if we get to a point where we're feeling like we may have to furlough teachers, or we may have to cut a program, this or this, but then I don't feel comfortable asking, you know, Dr. Kreider to consider that and talk to admin if it's like, but you know, we may have some money, but we don't know what it is. But because we've always budgeted this cushion, like, well, why do we have to have that cushion? Why can't we just say, so that we could be actually making decisions on what we need to, as close as possible? Does that make sense?
Risa, I agree with your concern. I don't have a good answer for it. I agree with that. I look at the revenue on page 56, the revenue in the audit thing. The local real estate tax revenue was up 178 grand. And that's 1% over the budgeted amount that we had. I don't know how we can, I mean, it varies by a little bit each year. The percentages go up and down. It could be up 100 grand, it could be down 100 grand. I don't know how we do a better job at throwing a dart at that target.
Last year, we didn't have the state budget until after.
Every year, we finish better than budget. Every year.
Right.
And that says to me that we are not trying to hit the mark, that we're always providing something so that we're gonna finish better. So we're underestimating revenues, we're overestimating expenditures, because every single year we finish better. And all I'm saying is, I think for the purposes of what we're trying to do going forward, we gotta try to hit that mark a little better. What you're suggesting is that it's okay for us to take the information developed and provided by our administration and say, I think they're wrong, I'm gonna discount it $200,000 or $300,000. I don't need to be cavalier with that, but in essence, that's what you're saying.
No, actually, what I'm saying is that I value, me personally, I'm not speaking for us, but me personally, I value having a tiny bit of cushion in that number, because the risk of failing on the wrong side is pretty
But if
severe.
you know in the back of your mind that that cushion is there, then I think it makes you.
It's kind of like
affects
you set your clock 5
It
minutes
does.
off,
It does,
but then you know like
I
it's
think
you're
it
5
is.
minutes off.
That's a good
So
one.
then why do you set it 5 minutes off?
Here, sit again.
Yeah.
Does that make sense?
It
That's
is.
like setting your clock 5 minutes off so you can be on time for things, but you know it's 5 minutes off. So then
Come
you
to my
start,
house and look at all my clocks.
but then like the habit is you start moving in a way where